Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today to whap and tap on your head with another ADH wealth solution. Today, we're going to be going over my investing series so you understand terms, etc., so you can actually be armed when you go to actually invest. And before I go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So as we proceed to give you what you need. Sometimes you'll hear things about investment, and one of those things is the minimum amount. Now, you can actually invest with credit. Let's see how that works. Can you invest using credit? Not a credit card, just credit. According to the Securities and Exchange Commission, most reputable firms don't allow the use of credit cards to invest. Okay, so no, you cannot use a credit card to invest, but you can use a line of credit to invest. Is it good to use credit to buy stocks? As the example shows, borrowing money to invest in the stock market is almost always a bad idea. Well, yeah, but this is about using credit cards. So let's see, how can you invest using credit? How can you invest using credit? Right? And they should show you a margin account. If you decide to use your credit card to make a balance transfer cash advance from your credit card account into your checking account, you can then invest directly from your checking account into your brokerage account. Okay, so what the way that you can invest into the account without a credit card is, what is a margin account? Okay, so there's first trade. Let's see. Margin account is a type of brokerage account which allows investors to purchase securities with borrowed funds, requiring a deposit of cash or assets as collateral to cover the risk of such accounts. Okay, let's see. Let's look at some more definitions. Here we go. Margin account from let's look at sec.gov. Investor Bulletin, Understanding Margin Accounts. Fuck Investopedia. Let's go to the Securities and Exchange Commission. So, the difference between cash and margin accounts. A cash account is a type of brokerage account in which you must pay the full amount for securities purchased. In a cash account, you cannot borrow funds from your broker-dealer to pay for transactions in the account. A margin account is a type of brokerage account in which a broker-dealer lends you cash, using the account as collateral to purchase securities known as margin securities. Brokerage firms may allow you to have both a margin account and a cash account at the same time. Understanding how margin works. Let's say you buy a stock for $50 and the price of the stock rises to $75. If you bought the stock in a cash account and paid for it in full, you'll earn a 50% return on your investment, i.e. $25. Gain is your 50% on your initial investment of $50. But if you bought the stock on margin, paying $25 in cash and borrowing $25 from your broker, you'll earn a 100% return on the money you invested, i.e. your $25 gain is 100% of your initial investment. For simplicity, this example does not account for the interest you would owe your broker on the $25 margin loan you used to buy this stock. After paying this interest to your broker, your actual return would be slightly less than 100%. The downside to using margin is that if the stock price decreases, substantial losses can mount quickly. For example, let's say you bought the stock for $50, but it falls to $15. If you fully paid the stock, you would lose 70% of your money. However, if you bought it on margin, you would lose more than 100% of your money. In addition to the 100% loss of your initial $25 investment, you would also owe the broker an additional $10 plus interest on the margin loan. Investors who put up an initial margin payment for a stock may, from time to time, be required to provide the broker-dealer with additional cash or securities if the price of the stock falls, a margin call. Some investors have been shocked to find out that the brokerage firm has the right to sell their securities that were bought on a margin without any notification and potentially at a substantial loss to the investor. If your broker sells your stock after the price has plummeted, then you've lost out on the chance to recoup your losses if the market bounces back. So that's going to be a little bit for today, ladies and gentlemen. Stop listening to these bullshit non-licensed people who tell you to buy their courses, because they're getting money off of their courses, not off of you actually learning to trade or invest or crypto or any of that. With that being said, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass, work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. By the way, I'll put this from the Securities and Exchange Commission in the video. Salute. Or in the description. Salute.